Okay, Netflix beat earnings by a lot, and the stock price went up a lot. Let's load this up in the stock research tool and take a look at the numbers of Netflix. So folks, if you sign up for the software, or the website rather, you're gonna get an invite to our Discord server. It's completely free. And with the Discord server, you can talk to me and other like-minded investors. We have just different chat rooms there, and we can just talk about everything from stock research to self-improvement, whatever you like to chat about. Loading this up in the software here, take a look at this lovely chart of Netflix. So I think it went up like 10 something percent today. But take a look at this, guys. November 2021 at a high of $682, plummets after earnings, plummets again after a decrease in users. And we're somewhere in this vicinity here, and now we've slowly been making our way up. And take a look at that, climbing up. Pretty much, we had a 52-week low, $162, and $700 on the high side. That spread is absolutely incredible. It's phenomenal. Now we're at $240 a share for this company. So what is going on with Netflix? What are they doing right and what are they doing wrong? Well, listen, earnings is obviously a huge thing and it's a huge proponent of any company. So for them to crush earnings, that's good. But is this reaction from investors overhyped? Is this company actually worth the 10% in, let's say, stock increase over this day here? Let's dig through the numbers from a fundamental perspective to try to figure that one out. Well, out of 10, it's ranked a 6 out of 10 with the financial valuations. Now, what this takes a look at, folks, with the software, it takes a look at the cash flow statements, the income statements, as well as the balance sheets, and 10 different categories, and grades the company based off of if it's making improvements or not. If it's making an improvement on those categories, it will get a point. If it isn't, it doesn't get a point. Simple as that. They have a really high return on equity average, which is important. We want to see a number over 15%, and we have that no problem with Netflix. And as well as their EPS, so their earnings per share, has been growing over the last 5 years. That's also important, and that number is huge, like 1,000% increase. So if you've been holding on to the share, or stock rather, for the last 5 years, that's super important to see that, listen, with their revenues, they're getting more earnings. So seeing this stock price decrease shouldn't really bother you that much in the grand scheme of things. Now, the net income is up, the free cash flow is up, the revenue is up, obviously. So that's a trifecta of things we want to see, money coming in, as well as the return on invested capital, the ROIC, sitting above 10%. That is also important because that means they have a great return on the capital that they've been investing. So those are all positive things for Netflix, and a lot of really good positive things. Those are pretty important categories. I would reckon out of the 5, or out of the 10 rather, 10 categories here. Now, what they are doing wrong, they are wrong in 4 categories. Now, that's their PE ratio. The PE ratio over the last 5 years has been an average of 107.51. That is an extremely high multiple. We want to find companies that are sitting below 22.5. Now, if you take a look at the company metrics category here, this section of the software compares the 5-year averages to the trailing 12 months. So you can kind of get a gauge of where this company, what this company's been doing and what they're currently doing. So it's comforting to see that our trailing 12 months PE ratio, it's 21.24. Which is great because we want to have this fair multiple with price. If the PE ratio is too high, that's usually an indication of a higher multiple, a higher premium for what they're actually bringing in. So 21.24, and that's largely due to this lovely drop that we're seeing. Remember, folks, when a stock price drops, it could be for the better. You know, buy the dip. That's usually what people say. And in this case, seeing this, and look, just take a look at this comparative. 21.24 for the trailing 12 months, and EPS for the trailing 12 months, 11.35, where on the 5-year average side, you have 107.51 as your PE ratio and an average of 5.23. So the lower PE ratio, higher EPS, and the 5-year average, a higher PE ratio and a lower EPS. Understand what I'm talking about? See, you want to get this number as low as possible while all of these have been going up, and Netflix has been doing that exact thing. So that gives me a little bit more peace of mind. So along with the, what was I talking about? The PE ratio, the current ratio is not that great. The current ratio is 1.14. it's all right. We want to see this number 1.5 or higher, and what the current ratio is just how many assets on hand, or how many assets do they have on hand to cover the liabilities. A 1-to-1 ratio means obviously one asset per one liability. I like current ratios to be above 1.5. That 0.5 gives us some extra liquidity in case things go wrong, like an upcoming recession that we are currently pretty much on the brink of, experiencing. So 1.14 is what Netflix is currently at. It's not the worst. It's not the worst, but that 0.5, especially with these uncertain economic conditions, that may be imperative. They also have, this is an ugly one though. The debt to equity is pretty rough. It's currently sitting at 92.71%. We want to see numbers underneath 50% or lower. Now that would indicate to us that they're leveraging their capital through equity and not taking on debt. So we want to see Netflix lowering that debt to equity ratio in the future, hopefully sooner than later, because that could be a major problem in certain economic times. Because here's the thing, folks. When you get into a recession, people are going to spend less, and it's going to be harder to justify having, let's say, Netflix subscriptions and stuff like that if push comes to shove. As well as with other competitors on board, they are making it harder for Netflix to actually, let's say, maintain subscribers. Because if you're finding that there's better content on, let's say, Amazon Prime Video or Disney Plus, you're going to leave Netflix and just go over there. I'm not saying that's what the case is, but they are all trying to fight for that main spot. Currently, Netflix, I believe, is the #1 subscribed platform, so they are still crushing it in that regard. However, something to consider going forward. And last but not least, the other little red flag that Netflix has is their share dilution. Their share dilution they've been diluting shares not by a crazy amount over the last 5 years, but they're creating more shares for the shareholder, and that's not ever good. That means there's more pieces of the pie that you have to share. Listen, what you want is a company that's buying back shares. You want companies to be buying back shares, or at the very least, keeping the share count the same. Them issuing out more shares, not the greatest. But here's the thing. They haven't been issuing out more shares, but yet this price of the stock has been going up by a considerable amount. I guess because it's one of the FANG stocks. So it's one of the FANG stocks, like the OG streaming platform. So there's a lot of hype amongst Netflix. And then with hype comes great downfalls. And let's just go over to the free cash flow statement. And let's see what that's all about here. So going to the free cash flow statement and just get a better look at what their free cash flow is looking like. It is not healthy. Take a look at that. Negative numbers across the board, except for 2020. 2020, they had a positive year of free cash flow, probably because everybody was inside. 2020 was a great year for streaming stuff. But everything else, negative across the board. See, these are things you got to keep in mind, folks. And if you want to get your hands on the software, head over to leodeleo.com. There's a free trial. And 7-day free trial, and it has all these lovely features that I'm talking about. It helps you research companies in an instant. Now, let's do a fair evaluation of this business. So we'll do a 10-year analysis of this company. And what I'm going to do here, folks, is I'm going to do 3 different assumptions using the historic numbers of this company. And if you want to learn more about how to use the software, there's a video. I'll attach it right here in this corner. It'll pop up right here. And if there's something that interests you, definitely come check it out. It's a phenomenal piece of software. I'm going to fill out these lovely boxes and we'll talk about it and to try to find the intrinsic value of Netflix and what you should be paying for it today. If you've been enjoying the video so far, hit that like button, hit the subscribe button, and to get the software, like I said, head over to leodeleo.com, 7-day free trial. Here is the price analysis section. So I'm going to put this up here, and I'll talk about what I did before we find out what the actual value is. What I did here, folks, is I did conservative revenue growths. So on the board here, I'm seeing 18%, 27, and 26. I'm going to cut that in half and try to give myself the most margin of safety as possible. So I did 10% revenue growth, 12% revenue growth, and 14% revenue growth over the next 10 years. And then profit margin, I kept that very similar to our 5-year numbers here. It's going 8, 9, and 10. Because it's in between our 10-year and 5-year numbers. So this is what I try to do, folks, is I try to pick out the most, I usually never use the 1-year numbers unless they are positive, in the case where everything's negative across the board. I try to stick within the 5 to 10-year numbers if those are available to me. because it helps me get a decent margin of safety in case I end up being wrong. So with a profit margin 8, 9, 10%, right, and free cash flow margin, here's the one part that I am speculating, is because the free cash flow has been negative over the last little while. I've done 0.5, 1, and 1.5%. I don't think like this is really being aggressive with it, considering how negative the free cash flow has been over the last 10 years. But this is my hope for them in the next 10 to see that, you know, maybe they'll turn it around. Price to free cash flow and PE ratio, as mentioned, PE ratio underneath 22.5 is important. And for price to free cash flow, same thing. So I'm sticking with 14, 16, and 18. And as for both numbers, desired return of 13%. And that will obviously give us our margin of safety, because on average, the S&P 500 gives you, let's say, a 10% return over, you know, historically. So with an individual stock, I'm going to put a desired return that is more so in line with, you know, a higher risk, right? You're investing into an individual stock, so you know what, I want to get something more out of it, because if the S&P 500 just gives me 10%, why not just invest there, right? So 30% seems fair to me. Sometimes I like to do 15%, but for these videos, 13% has been the magic number. So with this, comes out to be, with the current price of $240, pretty much red across the board, and the average price comes out to be $97. So folks, here is the deal with Netflix. Even though they've crushed earnings, and even though they're doing a lot of things right, this negative free cash flow is not healthy, and it's really affecting this stock price and the projections of what this company can do. Now granted, some may say my revenue growth numbers are pretty low for what the company's been doing, but you also have to factor in a key component. You have other streaming services that are competing along with them. So plus a recession, that's most likely going to happen. So you have a recession, other competitors, can they compete? Do they have enough things in the pipeline and content in the pipeline for them to actually keep subscribers and keep crushing the game? I'm not sure. That's why I'm putting this extreme margin of safety to give myself that buffer. So currently, aggressive category, $144, low end $55, but somewhere in the middle, $97 for this company. We are getting on the earnings multiple calculation $340 on the high end, so could play in there. But everything else, it's wanting 97. That is the average what we should essentially be paying for this business. So to answer my question that I asked in the beginning of this video about is this company's stock price going up justified? No, I don't think it is. I don't think it is, because just to have a stock price just jump up over the last, let's say, 9 hours because of the earnings doesn't make sense to me. Because you know what, the value of the company hasn't actually changed, and to be honest, it is extremely overvalued. And look, as our low end was $162, and which kept going down. People were right dropping the stock. People were right, because you know what, it's an extremely overvalued company for the time being. Now, folks, you want to see the company evaluated, drop it down in the comment section down below, or better yet, get the software and you can analyze companies yourself and you don't have to wait for me. It's a one-stop shop, guys. I have all the latest news on any company that's across the NASDAQ, Toronto Stock Exchange, Euronext markets, and we have it all. Income statements, cash flow statements, balance sheets, and charts to see everything from a visual perspective. So take a look, guys. 7-day free trial, leodeleo.com. The link is in the description box below. Thank you so much for watching, guys, and as always, I will see you in the next video.